Hey everyone, this is Ben. You can find me writing at the All in the Reflexes Substack at this URL, and you'll see me posting periodically, usually a couple times a day on X as different charts pop up and are interesting to me. So today I want to go through the calendar of catalysts that I'm working from. I've got this populated through the end of January, and I'll look to start to build in the dates of interest for us, for me anyways, in February. So I'll do that over the next couple of weeks. But right now, taking a look at where we are for January, we've got a confluence of a number of dates of, catalysts lining up around the 20th and the 21st. Usually when we get a bunch of these things clustered together, that gives us either a pivot point in the market or a little bit of volatility. So in this case, I've got these astrological tools that I'm working with the S&P, with gold and Bitcoin. We've got dates of interest that were identified with the Gann square of 9 on the 20th and the 20 for S&P and the 21st for gold. We've got historical seasonality, and this is for the S&P. We typically have seen the high for the month occur on the 7th trading day of January, and that's the 7th trading session, which is the 12th day. The low for January has typically come in around the 12th session, which would be Tuesday the 20th. We have a 5% drawdown alert that triggered for the S&P, for the Dow, and for the Nasdaq. The Dow and the S&P have cleared, but the monitoring window for confirmation for the Nasdaq expires on the 20th, and so again, that's tomorrow. And then we have the Foundation for the Study of Cycles has an app that does cycle detection. When I run that for the S&P and for Bitcoin, the cycle app comes up with a pivot point that is likely around going to be around the 20th of January. And then lastly, we've got VIX expiration. So this is expiration of options and futures contracts for the VIX occurs Wednesday the 21st. And so a lot of what we'll talk about today is the forecast and outlook for volatility. So again, several dates of interest. One that's not in here, there's Brad Cowan does some work that Blair from Time Trades has discussed in much more detail, and I'm not an expert in it, but the pentagonal, Brad Cowan's pentagonal identifies relationships between planets, and they tend to correspond to large changes in trend and price movements. And the next one for Bitcoin comes up at January 23rd, and we'll take a look at that too. So those are the key dates. Looking at the VIX, the middle indicator is the contango slope indicator, and contango is where the prices for longer dated contracts are higher than the prices for current month contracts, and that's the natural state for the VIX in bull markets. So we're looking at that in two ways. There's a blue exponential moving average of the VIX divided by the 3-month VIX, and that's a 10-period EMA. And then the black line is the same formula, but it's a 100-period EMA. And so it's comparing the two of those. The 100-period is the overall trend, and the 10-period takes us, identifies extremes in movements of the VIX. I'm overlaying this with a 130 period cycle and a 38 period cycle that I identified with the Cycle Analyzer app. And so what we've got is the 10 period contango slope is made an extreme low at the end of 2025, and that's the lowest reading of it going back to 2022. Now it looks alarming, right? Because you've got this low reading, and then we go into an extended bear market. But extreme lows should show up periodically in the context of bull markets as well, and they're not necessarily followed by huge drawdowns. Like we've got this one in the summer of 2020. We get a VIX spike up to about 30, and then we draw down from 35.60 down to 3250, so we lose 100 points in the S&P, but that's in the context of this like multi-year uptrend, right? And so it tells us to be aware of potential for volatility and a drawdown, but not necessarily a reversal in the market. Next, we'll look at the center indicator is the standard deviation of the VIX in teal, or I'm sorry, in blue, and the standard deviation of VVIX, which is the volatility of the VIX. And this comes from Andrew Thrasher's paper called the Volatility Tsunami. When both of these fall below their threshold and the lines turn red, we paint the background red. This is a warning that we're likely to encounter a steep spike in the VIX, and they usually come within, I think, 2 to 3 months. And so the thresholds that he identified in his study are when the standard deviation for the VIX is below 0.87 and the standard deviation for VVIX is below 3.17. If we have both of those conditions together, we get this alert. Right now, we're not close to it, right? The VVIX standard deviation for the VVIX is higher, but the standard deviation for the VIX is pretty low. It's almost to that extreme. So it's not a signal yet, but it's just to be aware that this is a very compressed state for the range of price movement for the VIX to be in. When we look at the VIX with that 38 period and 130 period cycle, we can see the red tags here are the alerts when we're getting that compression on the VIX and the VVIX, and you can see they're followed not immediately, but they're eventually followed by these spikes in the VIX. The blue triangles are instances in which the VIX is 10 points above its 10-period moving average, and those aren't necessarily a perfect reversal signal, but using those extremes in conjunction with the upper Keltner channel rolling over and confirming its high, that's always told us, given us confirmation that we've seen the local low of a move down in the S&P. Bring in the S&P real quick. So you can see, in the past we've had that, when that Keltner channel rolls over, that's our confirmation that we're now past the low in the VIX, and that's 100% of the time. So that's a pretty strong indicator for us. But what we want to be aware of here is that we're moving. VIX had put in its low at the end of December, and it's gradually drifting higher. It's above its 10-period moving average for several consecutive days, despite it being a very tight range of movement. We've got that expiration coming up on Wednesday. I wouldn't be surprised if the range of movement in price of the VIX starts to become a bit more extreme after getting past that. That's the scenario that we want to be prepared for, because it could be accompanied by some drawdown in volatility in the very, very short term for the S&P. A couple more perspectives on VIX. This is the seasonality chart, and so this is annual seasonality. January historically has closed with the VIX higher than it opened 60% of the time over the last 20 years, and with the VIX moving 7% higher. It's the third highest average outcome for the VIX. August and September are higher, but slightly lower in history of closing higher relative to lower. If we look at the annual seasonality across the 4-year presidential cycle, what's interesting here is that January is one of the most extreme months of the entire 48-month cycle. So January, during a midterm election year, 70% of the time the VIX is closed higher, and on average almost 13% higher. The only month more extreme than that is October of an election year, and we can see that those closed, nearly 90% of those have closed higher than they've opened, with almost a 24% movement, and that sets up a pretty decent opportunity to short the VIX, because it's had a very low historical performance in the following November, usually falling by about 17%. So that's the seasonal perspective. If we take a look at cycle detection through timing solutions, I know this is very, very busy. The black line is the VIX. You've got a blue line is a shadow annual cycle that's inverted. The green line is an annualized similarity in price movement, and I should have changed the colors on these so they're easier to tell apart. But the navy blue line is a Mars Saturn helio cycle, and then they do like a dynamic composite in the bottom window, and so what we see is that it's super busy, so it's like not easy to interpret at a glance, but you've got confluence of a low in multiple of these cycles occurring at one time, and then they all rebound and move up at one time. That's the signal that we want to look for. The clue that we want to find in this tool is when you have multiple cycles making a peak or a trough at one time. Those are more likely to be a pattern of price behavior that we'll see. So this is a look back at the cycle detection from 2023 through 2025. We do a walk forward and pause the study at the beginning of July so that we're not influencing the outcome of the study with the most recent data. And you can see again we've got this like confluence of the cycles making a trough. And that's right in here where we got that low of the VIX in the summertime. The cycles start to anticipate a move higher. That's when we got it, and now we're back in a situation where we've got multiple of these confluence of multiple cycles anticipating a low, followed by a pivot, and so this is just another data point suggesting that we're at a time period in the year where we're likely to see a move higher in the VIX. Speaking of that Mars cycle that we saw on the timing solutions tool, this one is these are the time trades tools that you can find at time-trades.com, and this Blair has a channel on YouTube where he goes into a lot of detail about how these work and provides a lot of great examples. But we've got the vertical lines are the square of 9, and they're configured to Mars, and we've got two GAN fans, one from the 2019 low and one from the COVID spike high, and they're anchored to close, and so all of these are configured to Mars, and what we can see is that the extremes in movement of the VIX tend to navigate around these ascending and descending lines, and we tend to get transitions from either swing low or swing high at the verticals, and including these great big spikes in 2024 and 2025. So we've just passed one of those transition points at the end of December. We're back above the descending line of the GAN fan, and so I'm thinking if we do see this, if we were to see a spike high in the VIX, I'd say it's probably going to run into resistance somewhere in between this 23 and 25 level. Hopefully we don't see if we do see something over 30 points and it reverses, those are a pretty strong buy signal, and I'll post about that if we see it. But I'm guessing that we're going to see, if we see an extreme movement, that it'll probably bump into resistance at either the descending or the ascending line, and then it'll return to a low probably by the early point of March, aligning with this vertical. So that's my outlook for volatility. The most important thing is that we're prepared in case we see more volatility than normal. At the early point of this week, we would know that would make sense to us, and we wouldn't need to panic or overreact to it. We would know how to work with it. Taking a look at the 5% drawdown signal. So this is Andrew Thrasher's other paper where he identifies that we put in a new 52-week high, and if we fall more than 5% from that new 52-week high, that's considered an alert and putting us at higher risk of a deeper drawdown. But those have to be confirmed. So if we fall more than 5% within 15 sessions, that's an alert. If we see the alert, then our confirmation comes if we see price close below the 200-day moving average for 2 consecutive sessions. And so we got those alerts for the S&P, Nasdaq, and the Dow back in November. The S&P and the Dow have cleared those alerts and gone on to make a new 52-week high. The monitoring period for a 5% drawdown for those is open until February 3rd. We got the alert for the Nasdaq back on October or November 17th, and the 42 sessions for looking for a confirmation of price closing below the 200-day moving average would be tomorrow, the 20th. And so the reason that that's important to me, a lot of what we invest and trade in is Nasdaq and tech, and so I keep an eye on this. I would take this to mean that, if we start to see retraces down to support, that those are buying opportunities for longer term positions, and possibly for short term trade setups. I don't want to be too aggressive with it until like the charts have to make sense and they have to be the right opportunity. But that tells us that we haven't seen a signal from this tool that would alert us to the risk of a very deep drawdown. And I take this signal very seriously because some of the worst market outcomes in the last 50 years have come when we get those two closes below the 200 as confirmation. And so again, that expires for the Nasdaq on the 20th, and we just have to monitor the S&P and the Dow through February 3rd. A look at Bitcoin using the astrological tools. So these are anchored to the all-time high, and they're configured for Mercury. We enter Venus interval 4 at the beginning of January, and Bitcoin has always exited Venus interval 4 lower than it entered. So this is a pretty bearish interval. So this is the position of Venus relative to the Sun and to the Earth. And so this period of time has always been relatively bearish for Bitcoin. And so we've got our Ganfan anchored to the high and then one to the low. And we're using an anchored VWAP from the all-time high. Another one where we retest that anchored VWAP from the all-time high and it fails. And you can see prices, these are strong sentiment indicators. We want to see price get above these and have a successful retest that it rebounds from. And instead we get a failure into the one from the October failure, and then we break above it, but we quickly lose it again. So this is telling us that participants are looking to cut losses in Bitcoin, not looking to accumulate and go on a bull run. This is fairly bearish behavior, particularly when we fall below a level of support at an intersection between an ascending and a descending line, and that's exactly what we got. So we get a little pop as soon as a swing low and a swing high right into the beginning of Venus interval 4. My thesis has been that we would see price break above that anchored VWAP and then put it a lower high and then come down and make its low for Venus interval 4. I'm still looking for that, and the evidence of it I think is going to be if this 91,000 level holds, because that is a combination of the square of 9 level and the anchored VWAP from the December 18th low, and then we've got this this date on the 23rd, which is the pentagonal date for Pluto Earth. So I'm thinking maybe we come down, squeeze in between these levels a little bit, make that low on the 23rd, and then see that higher low pop up in a higher low. That's a scenario that I'm not going to say that I'm expecting it, but I won't be surprised if I see it, and I'll take a little more profit off of the table for Bitcoin, and then just sit tight for the rest of Venus interval 2. I'll probably even buy some IBIT puts, but I still have to evaluate that against other opportunities. A look at it with the more traditional chart. This is where I drew this pathway as a scenario a couple months ago, and it's played out pretty well. So I'm looking for something in this green box to be the area where I take a little more profit off the table, and then I'll just kind of wait and see what it does by the end of interval 4, and look to participate in it. And so these are never predictions. I say this all the time, but not a prediction, just a scenario that I would know how to work with, and if I see it play out, I know how to participate. If it does something different, then I start over and I reevaluate. S&P using the same tools. These are anchored to the September eclipse period, and we've got an eclipse coming up at the in the middle of February, and so I've done a reverse Gann timeline using the Fibonacci timeline tool and just configuring it manually. And you see with eclipses, you see influence on markets and price a couple weeks to a couple months before they occur, and we're starting to see swing low and swing high associate with these vertical levels in that Gann fan or in that square of 9, using the the one that's configured to the prior eclipse. So you're starting to see these pivot points drift from the square of 9 anchored to the prior eclipse to the one that we're forecasting from the future eclipse. Once we get there, we'll set up new tools that are configured for the astrological environment at the time. Taking a look at gold, this is gold futures, so it's a market that's open different dates than than the S&P. For instance, this market's open today, and so this one has a date of interest on the 21st, and these levels have been very well respected. We've got the Copic curve is above its moving average and moving higher. Those tend to, those crossovers tend to see a little bit of follow through with them. I can delete that alert. So we're really volleying in between the upper level of the ascending line and the lower ascending line in the Gann fan from that September 22nd eclipse. So I'm thinking if we continue to drift higher with gold, it'll probably continue to respect this upper angle in the Gann fan, and if we see a retrace and a retest, it'll probably come back down to between like 45.50, 45.15, and 46.50, and it'll probably test those levels and not run all the way back down to this lower angle in the Gann fan. But we'll just have to monitor and see. I'm very patient and long term on gold at this point. I'm not using it as a short term trading position. And when I look at gold, I'm looking at it on this 8-year chart. And so we're looking at this multi-decade chart with an 8-year cycle, and that's this larger cycle that we've got going on. And you can see I've covered this a couple of times, but we make our high in this 8-year cycle around the 3/4 mark of the cycle. So it would be unusual for us to, despite gold being very very extended and having had a really phenomenal run, it would be unusual for us to make our high at this juncture in the cycle. It tends to overshoot the sine wave and make its high 3/4 of the way through this 8-year cycle that we've got drawn. That would take us out to the fall of 2027. So I'm not looking to chase gold. I'm not looking to take additional profit in it right now. I'm looking to sit tight and let that thesis play out, unless we see a reversal that's compelling and we need to protect. I need to protect some profit and do something different. I'm gonna plan to participate in this longer term, slower moving cycle. But these are things that I do personally. I change them on the fly based on what I see. This is not advice for anybody else. These are just transparently sharing my perspective on the markets and helping to keep track of my evolving outlook. But everybody's got to manage their risk independently and make the decisions that are best for their risk tolerance and risk appetite. But I hope this was helpful for others and educational. If anybody does have questions, comments, recommendations, I'm all ears, and you can feel free to reach out to me here or on my Substack or on Twitter, anywhere that any of the multiple trading groups and investing groups that I'm in. But thanks for your time and thanks for following me.